Hi, Adi Loran from Middle East Technical University. I have a question about what's your favorite valuation approach? Do you have one? Do you use more than one? And what do you use at first? How about later?
Valuation approach. The magic black box, right? You just put it in the black box and then...
I'll tell you the favorite valuation that was presented to me, and I won't even tell you what the business is because I don't want to give it away, but one entrepreneur once walked to me with an idea that of an established business in country X, and this person wanted to do it in country Y, but there was nothing. It's just a piece of paper. And then this person told me, well, when I do this and this and this, in 3 years, 5 years, this and this will happen, and therefore in 5 years this will be a $500 million company, and if I MP with that with 20%, the value today is $20 million. That's good. So I would avoid that approach because, by the way, this is a real example. I swear I'm not exaggerating. Okay, it was 17 million. The figure told me 17.5, I think, but literally somebody looked me straight in the eye, looked into my eyes, and for a piece of paper with nothing, like no IP, nothing, demanded a 17 million valuation. And, in this situation, you kind of feel like, okay, is this a real entrepreneur? Does this person really have sufficient life experience to run a real business, let alone grow it? So I think this is one reason why it's probably not such a wise idea to start with the valuation. It can scare off investors, because if the first sentence that an entrepreneur says is like, my business is worth $10 million and I want to sell it to you, that's not a big vote of confidence in the business, right? Because you want the entrepreneur to say, it's worth $10 million today, and I think this is going to grow huge, and I want you to be a partner of it, and give me capital to help me grow it. And I think this is something that a lot of entrepreneurs often forget. Sometimes in the heat of things, and other times because actually they actually want to sell it to you. But I would really pay a lot of attention to that if I were an entrepreneur, and if I would talk to the VCs. It's not less about the number. It's much more shows a lot about how you think of the business. And it shows a lot about how you think of your relationship with your future investors and what you're trying to get out of the relationship. Now, as I was talking about expectations earlier, and this is this is kind of the thing that would give me immediately red flag. This person has very different expectations than I do in terms of, and I would probably pass that deal in 3 minutes.
Go ahead.
Okay, this is, I'm the IP guy, so I have to bring this IP stuff here. I don't know. I'm not only one guy who had some IP-based business plan that I met here. I don't know if anybody else is there, but I also want to put it out there. When I value an investment, I have to first start by valuing patents. Patent valuation is more an art than a science. Market approach is the best, it's the most reliable, but it means that your patent is not that innovative, because it means that there are other examples that you can benchmark on. So that is always big question, especially at early stage technologies. It's more of a gut feeling than anything else. You run 3 tests, the classic, the market approach, cost approach, net present value, and then you see if you're more or less in the ballpark. If you have 100 million evaluation in one and you have 1 million on the other one, something is wrong. So that's one thing I wanted to say. Then we build the business plan around it. And I want to illustrate with 2 examples. It goes with what he says. In one, and also about how do you manage your, what investors want from entrepreneurs. Many years ago, we were negotiating a licensing deal with a large German company with the scientist. Things were going well until, as I was flying back to Turkey, before I landed, he managed to send an email saying, well, you can have this technology, this patent portfolio for $1 billion. 1 billion. 1 billion. Billion, yes. Like Dr. Evil, right? Of course, we never heard from it. So an entrepreneur can really screw up the deal. The other example, a much more recent example with the valuation, is that we invested about $150,000 as a proof of concept fund 2 years ago. So the valuation was of the company about $1 million. The big risk was patentability of the technology. So throughout that period, we managed to validate the problem, get a solid patent document. This company just last month received $4 million of financing. So that's pretty good for 2 years. And it's 2 patents. So it's really a chance thing. Also your synergy with the entrepreneur. If you see you make the same assumptions, you have the same vision, if you can work together. So it's really mostly art as far as I'm concerned than science.
Any other comments on the art evaluation?
I mean, it is very correct. The evaluation is more of an art than a science. It's a lot of times very subjective, and basically the market, the competition may end up the determining factor as to where you end up in the valuation horizon. So the more people are invested in your company, the higher valuation you can get, the less valuation you're going to get. That's as simple as that. But from the entrepreneur standpoint, yeah, valuation is important, but what is also important is how efficient you are in your capital raise expectations and needs going forward. Therefore, from an entrepreneur standpoint, instead of focusing so much on the valuation, the entrepreneur should be focusing on the size and the timing of the capital raise, okay, and the planning for the capital expenditures. So the less you raise, the more valuable you will have, of the remaining shares, okay? So I think that should be more of a focus than the absolute valuation numbers. And on the valuation, the more competition you can create among the various investors, the better off you're going to be.
Yeah, and I would sort of agree with a lot of that. And at the end of the day, you do a lot of calculations, and you put together sort of plans. You look at comparables, and then you, especially when you're doing sort of any kind of NPV as well, you look at a discount rate. And when you change that discount rate from 20% to 60%, it changes everything. So you can do all these careful calculations, and then you've got this big dial that you twist, and the number goes from nothing to some huge number. And a lot of it really comes down to sort of judgment. I would agree that obviously the more competition there is, the better you are as an entrepreneur. If you're about to run out of money and you've only got one term sheet on the table, it's going to be very difficult to really sort of negotiate that up. If you've got multiple parties interested and you've got some different term sheets, then you obviously have a lot more leverage, and from your standpoint, you have a better opportunity to be able to kind of raise that up. But yeah, it's not sort of a one simple way that you come up with it. There's so many different factors that go into it. At the end of the day, it's a negotiation, and the more leverage you have, the better off you're going to be.